Okay, very good morning. Hope everyone is well. Wednesday, the 29th of November. Quite a few things to get you up to speed on. I'm sure you've already read the headlines concerning Brexit. A lot of volatility we had in the pound late yesterday. We've had some developments with North Korea. We've had all-time highs in US equity markets. And so hopefully we can explain a bit of reasoning behind why the market's moved in the way it has to these different fundamental news events. So that's what's on the agenda, and looking at the chart to get things underway, I think let's talk firstly about the US equity move that we had yesterday. Just looking at the S&P chart here, and really the US returning, of course, from their kind of Thanksgiving slumber, and markets really wakening up substantially, having broken more firmly that previous all-time high just around the 26.0506 area, and we just continue to power higher once Wall Street got underway, and we've held on to the large portion of those gains irrespective of the renewed escalation that we've had from North Korea, and we'll explain a little bit why when we look at that story in more detail in a moment. Now, why did the US equity market rise? Well, there's a couple of key points here, not only technically just breaching those previous highs, but really three main things that people are looking at. And one is, of course, yesterday you had the testimony from Jerome Powell, who's obviously the incoming Fed chair that will replace Janet Yellen come the beginning of next year. Now, everyone's kind of hanging on Powell's words as to how he will govern the Fed and direction of policy going forward into 2018. And it wasn't so much monetary policy. We know from a monetary policy point of view, Powell is very similar to Janet Yellen. And that very much was reiterated yesterday. We knew that this time when we did the briefing on Tuesday, because the actual commentary on the policy and economic assessment side of things was very much a continuity of Yellen's slow, gradual approach. The one thing that's slightly different with Powell, and we have known this before, but we got confirmation of yesterday, was that investors appeared to like his remarks on potential regulatory easing on the financial sector. Now, that was always something of which Trump's been pushing for a while, and of which Powell definitely fits the ability for Trump to succeed on that specific topic or area as part of his administration's proposals. And so who's the biggest net benefactor of deregulating of the market? Well, the specific sector that we were looking at yesterday were the financials. And if you think about the S&P on a sector breakdown, after technology, financials are the second largest representation. And US financials were up 2.6% yesterday, which did see then the S&P rise just shy of 1%. Now, that doesn't sound like a lot, 1%, but don't forget the average movement in the S&P of 2017, day-to-day kind of fluctuation of prices, is less than 0.2%. And we rose yesterday about 1%. So definitely a much bigger day of market movement to the upside, and predominantly driven by the fact that financials took a sharp boost on some of the commentary on that deregulation front from Powell. That wasn't the only thing. Senate tax plans appeared to be heading in the right direction. Deutsche Bank talking about this in their note this morning. The Senate Budget Committee voted 12-11 to send the tax bill for debate. So things are progressing on that front, still a long way to go. And then thirdly, check out the economic data out of the US. I mean, I was off the desk at the time, but I know Safe was covering this for you guys. But US consumer confidence, fresh 17-year high. Richmond Fed Manufacturing Index, the highest since 1993. US economic data just continues to more or less hit it out the park. If you think about the housing data we had as well, more recently, up at a similar type margins, extremely strong levels, and ultimately the consumer confidence is one of the key ones. As much as what you might think about Donald Trump, the US consumer at the moment continues to remain at a 17-year high in terms of current confidence levels, and that's absolutely imperative for the long-term continuation of this economic recovery that's underway in the US at the moment, certainly going into 2018. So hopefully that explains a little bit about the rise that we had in the equity markets. Now, the other thing, of course, that happened, and I just happened to be in the office still a bit later last night, and so managed to catch this event. This is cable, pound, dollar futures on a 1 minute chart, and at 5:42 I was actually on the other side of the office at this point, and I heard Ranscourt shouting on the microphone a breaking news story on the Telegraph. Have tweeted basically Britain have now made an agreement on a divorce bill, and they were throwing out numbers like 60 billion, and immediately I just came bowing over to my desk, started slamming the table and shouting. There was a couple of people still here. Saif was here, and I know he traded that. A few of the other trainees got to see that live, which was good. So a couple of questions that I have had though about this. One was, we'll talk through exactly how it happened. We'll have a bit of a recap, and then also a few other points. First of all, this news came out on Twitter first. It did not come out on Bloomberg or Reuters or Sky News or in the traditional media kind of formats or channels. This is the reason why Twitter is such an incredibly powerful tool for certainly intraday trading, because the way that news works is that people at Bloomberg are, although this is slightly different, one of the main points is at Bloomberg or Reuters, you are not allowed to comment on market rumor or speculation. You can only comment on validated information. So if you're at Bloomberg and you hear a source comment, you can't actually say it. You have to then go and verify it and say whether it's the same or different. So inherently that increases a delay in your ability to respond to the type of news that's unofficial in that sense. One of the great things about Twitter then is obviously you're getting first-hand information. The downside, of course, is the quality of information. So you've got to be very careful of who is it that's saying it, what's their agenda and so on. But the main thing is that yesterday this came from legitimate source. This was the Telegraph itself who broke the news. And so this was the tweet that came out, and then this was the accompanying story, and it said basically British and EU negotiators reached a deal over the so-called Brexit bill, opening the door to a breakthrough. Sources on both sides confirmed an agreement in principle has now reached over the EU's demand for a 60 billion euro financial settlement. What happened? And actually this is a minute chart. It took a little while for the market to pick up pace. This was actually 1 minute, 2, 3, 4, 5 minutes of continued move higher. And the reason why this took a little bit of time to build a bit of traction, if that headline came out, let's say hypothetically now at 8 o'clock, 8:30 in the morning London time, I can guarantee you the chart would look a lot different. You would have had a much more aggressive initial move on the first candlestick here. But what happens is this is a function of the time of day. Don't forget that UK European participants are not in the market, really. They've gone home at this point. And so inherently there is a bit of a delay, because traders in America are not following things like the UK British Telegraph Twitter feed particularly closely. What happens then is brokers hear people like the Squawk covering the news. They then spread the information. It then goes like wildfire on Twitter pretty quickly, and then it starts to go on the traditional news wires like Bloomberg, start picking it up. Then the market starts to pick up pace. What this does offer you though is an extremely great an arbitrage in terms of speed. If you know the kind of the legitimacy of the source of which this was high, and then also the fact that most people have been talking about the increase that Theresa May would make from 20 to 40 billion, the spinning of 60 billion as a financial settlement was an immediate kind of buy signal to get into the market aggressive at that point. And then one of the things here, if I just mark this up quickly, was the actual pivot levels were a pretty good guide actually to trade that move. Not only did you have plenty of time to get into that trade, when it went higher, you had the initial moves to S2, S1, and at that point, after breaking that S1 level back above it, that was also the 133 handle, so you can see then, again, a little bit of further momentum, and then it came back to the level all the way pushed up to pivot, of which at that point was when we were talking to some of the traders about looking to book profits, but you're looking at booking profits there with a move where the very comfortable amount of time to get into that trade up to the high at pivot. You're looking about a 0.78% appreciation, and looking at a tick value or pips, 100 pips over that period. So yeah, really good opportunity to trade the news in that respect, because you've got an advantage of the fact that because we're in Britain, because Brexit is such a focal point of what we're looking at, we are generally, as day traders, more better equipped to respond in a faster fashion than our North American counterparts. The other thing is, why did the news come out at the time that it did? That was another question that I had. And one of the things is, just from having friends who work at these various different news agencies or as journalists, how it typically works is, Britain and EU negotiations, although they happen at these verified meetings in Brussels, don't fool yourself, these conversations behind closed doors are going on every single day, every moment, in order to then get to a point, given the gravity of the situation, to make a deal. It isn't that they just meet every 4 or 5 weeks, come to a table and sit down. They'll be talking plenty behind closed doors. Now, what normally happens is that these discussions obviously are taking place during the day, and in Brussels time, this would have been about 6 p.m. last night. Essentially, your contacts then, if you're a journalist, you'd be contacting your people in Brussels who would, on conditions of remaining anonymous, give you a tip-off of how the talks are going. And so at that point then, you run the scoop and they break the news, and then you get this movement in the market. So that probably makes sense in terms of the time of day of why it came out at that particular point. Now, obviously, the second big move, and actually the move that was much quicker than the first one, was actually this one here. And so approximately half an hour later, you had a really quick, sharp move here. You can see pretty much a full 100 pip reversal. Now, that reversal happened because I was here when that came out. It took about, I would say, 3 seconds for the market to drop 100 pips. After it took approximately 5 minutes to rally up to that point, and then the whole move took about 20 minutes or so. It fell in about 3 seconds. That was because there was a British government spokesman who came out and said, actually, we are not able to verify what the Telegraph have said. And so, basically refuting what the Telegraph source was suggesting, the market dumped. But one of the things here to learn is that whenever there is a source comment, irrespective of whether it's the Telegraph or someone else, this is very much the function of how news agencies work. One, let's say the Telegraph will break the story. Now, if you're at the Times or the Independent or the Mail or wherever, if you're a journalist on that news desk, you are absolutely getting it in the neck from your boss, going, why on earth have you not broke this story? We are way behind the curve. You need to pull your finger out and get a response to what the situation is here, and we need to break something ourselves as quickly as possible. And as you can see, what happened then, if you're at the Times, you immediately call number 10, the press office, you call the government, you call your contacts in Brussels, and then essentially you come out, say the opposite thing. The main thing is here, the more that these news agencies can move the market, the more that traders inherently have to use their resource. And so it's good for them in that respect. Why did the market then recover, and why are we trading now where we are, where if you look at it in the present day, we were trading before the news came out 132.40, we're up to 134.22. We have traded 200 pips higher from where we were when that news broke last night to where we are this morning at R1 on the daily pivots. So why has the market continued to rally? Well, the main point behind this, I would say, is there is no smoke without a fire. And as I've been talking about for a couple of weeks now, increasing the divorce bill in order to secure and appease the European side of the negotiation to secure a transitional deal is inevitable. I am 100% confident of that. I just think that there's too much to lose here, not just for Britain, but for Europe as well. A deal has to get done. And once that transitional deal does go through, this then negates any uncertainty about the medium to kind of 2-3 year horizon, which is absolutely critical for the likes of businesses, which we've heard, who are thinking about moving thousands of jobs to mainland Europe and so on and so forth. In order to make investment decisions to safeguard the UK's economic prospects going forward is based on having clarity over this period. We secure a transitional deal, that cliff edge scenario of the most negative for the UK is removed. And so this is a net positive for the pound. And so we continue to move higher. The timing of this makes sense. We already heard from previous sources that Theresa May was working on this for a December 4th, which is coming Monday, where she's going to table the actual offer. And this, of course, front runs then the EU summit, which takes place in mid-December, for her to get the deal done, which is looking more increasingly likely today than it was yesterday. And so the price of the pound needs to revalue for this renewed expectation. Now, just having a look at the pound on a daily, and then let's have a look on a weekly chart. If a transitional deal is secured, now we've still got a long way to go, and it's still not, a completely done, signed off deal at this point. So things could change. But let's say at the EU summit, a transitional deal gets ratified across all other European nations in their respective parliaments, and therefore Britain's got secured an additional 2 to 3 year period to discuss then Brexit going forward. I have no doubt in my mind then we would definitely retest the September high, which would be 136.95, so that 137 handle. And then looking on a weekly chart, I don't really see any reason why we won't go to 140, 145, maybe even 150 for the full reversal of course, the point of which we were trading a year-to-date high when we initially had the shock event of the EU referendum night of the results itself. Because the status quo remains, and life goes on, as much as the Bramonas like myself might be personally dissatisfied with the situation. I've got to face the facts and just roll with the punches, and this pound is going higher when that transitional deal goes through, which I do think is inevitable. So that 137 handle will be very important. And then you're talking about the round figures, but then it's just a pursuit of reversal of the initial EU referendum result. And then above there, I don't think 150 can be ruled out when we go forward, because if you think about the Bank of England's pricing at the moment, I think it was way too dovish about what happened in terms of a next interest rate hike. We're talking about 2 by 2020. But if you think about the key risk for the UK is higher inflation. If the pound starts to recover, that then should counteract then rising inflation. And therefore, if inflation starts to taper off a bit, the economic engine starts to fire again in the UK with more renewed confidence for businesses and consumers, and then we might start to move higher again. Okay, contingent, we do need things like wages and so on to start picking up as well for the whole complete picture to pick up. But from the negativity where we currently are, which is a cliff edge risk, the worst case, certainly if this whole deal breaks down, let's say, given the pricing where we are at the moment, and they don't secure a transitional deal by the year end, well then I think definitely we've got to start pulling back down to the 130 handle at least, which defines then the low and support point that we've seen really since October, November. And then the longer that grinds on, if we were to get hypothetically into Q1 and there's still no movement on the transitional deal, then we're going the opposite way. 120, here we come, back down to the 2017 lows. So the main point here is it's really pivotal about this short-term deal in order to then safeguard the prospects for the UK over the next 2-year horizon in particular. So that was the pound story, and hopefully it gives you a bit of an outlook as well. This is one of the other things. I did tweet this morning if you want to read it in more detail. But the FT came out quite quickly after the Telegraph and said that Britain has bowed to EU demands and agreed to fully honour its financial commitments as identified by Brussels. According to several diplomats familiar with the talks, UK would assume EU liabilities worth up to 100 billion euros, although net payments discharged over many decades could fall to less than half that amount. The one issue here that could throw a spanner in the works and actually mean that the UK's inability to deliver a deal is still the contentious question over the border between Northern Ireland and the Republic. That still really has not been addressed yet, and is a real sticking point that definitely needs to be done in terms of the eyes of Europe. So again, you could be in for more volatility to come, and definitely needs to be watched ongoing. Okay, next point is North Korea. A couple of you guys were talking about this morning, so let's have a quick overview. I'm not going to talk about this much because it hasn't really moved the market much, and we'll see what they've done and why the reason for that is. This is the headline: North Korea says nuke push complete as entire US is in range. And so actually, you know, it sounds a bit weird, but I was looking at some of my graphics for the missile suite of options of which North Korea had last night. A bit sad, I know, but the Hwasong 15 missile is a brand new one. The last one they had was the 14 prototype, essentially. So they've now improved the missile technology. What's happened then? Kim Jong-un made a statement overnight claiming his regime's missile launch showed it can strike the US with a nuclear weapon, signaling a new phase in its standoff with Trump. North Korea is successfully launching a new type of intercontinental ballistic missile with improved technology that can deliver a nuclear warhead anywhere in the US, according to the state-run Korean news agency. Now, how did Trump respond? Well, in a very Trump fashion, he just said, "I'll take care of it." So you've got to watch out for the kind of rhetoric that he says. That comment in itself is not particularly aggressive, but if he does up the ante on that side, then certainly it could create some risk-off environment. But a couple of things to look at here. One is the range of the missile. Now, if I actually flick to this chart first, we've seen multiple missiles being tested by North Korea. The interesting thing here is the distance at which these missiles is covering. Now, this was July, end of July, and if you actually notice, it's been pretty quiet from North Korea for the last couple of weeks compared to what it was in the heat of the summer. The main thing is here is the distance of which these test missiles are traveling. So we've gone now to 4,475 kilometers, hence pretty much the entire landmass of the US in North America has been brought into focus. Before, we were looking at half this distance just a few months ago. Now, if you think about Guam, now going back about 3 or 4 months ago, Guam was the one that North Korea were threatening. Guam has a huge significance because of the high presence of the US military in order to safeguard and keep peace within this high degree of tension amongst the likes of China, Korea and Japan, and trade passages and so on and so forth. Now, if you look at Guam, Guam was only about 3,500 kilometers. So you're talking about an additional 1,000, which then is what brings the US into line. Now, why hasn't the market moved? Well, this is a good graphic looking at the frequency and history of North Korea's missile and nuclear tests. And as you can see here, this is not uncommon. This is in fact the 21st missile test that we've had of 2017. So we're at 2016 levels, there or thereabouts. So it's not particularly new information. And the important thing was that when this news headline hit, and I was here last night, gold actually went bid about $3 pretty quickly. $3 is not a huge amount, but does show that kind of flight to quality reaction. Because the key there, and if we do get another North Korea missile launch in the future, the key is where does the missile go? That's important. And within about, I would say, 4 to 5 minutes of tracking the missile online, using Twitter as a pretty good source for it, the missile landed in the ocean, like it always has done so far. But the escalation, obviously, in the future, if gold was to rally not just $3, but I'm talking $300, even higher, to the point where if that missile ever, God forbid, hit Japan, that is the beginning of the next world war. And so, you know, forget about 300. How about $3,000 in gold in that situation? So that's such a low probability of that ever happening. This is again more a case of North Korea flexing its muscles in order to just send a signal to Trump and the US that, don't forget about us, given that it's been pretty quiet. I think the main thing here, you look at the S&P, you'll see how much the market really cares about this North Korean issue. Here we are, all-time record highs in the equity market. Not a market reflecting fear that we're about to step into a new world of nuclear war. Gold as well, up flat on the session, but interestingly around the $1,300 level. One final thing and point I want to say to this, if you haven't seen this already, I do suggest you check out this link. It's just, I find this stuff quite interesting. How would the US defend against a North Korean nuclear attack? A really good infographic actually from Bloomberg. Basically it gives you a countdown from the moment a missile is launched from North Korea. And this is the US here on the right hand side. So you can see the ticker and the flight of the missile changes over time. And then basically it gives you an explanation of how the missile is then tracked. So essentially these are US naval ships which are tracking all of the time, second by second, monitoring the airspace to pick up activity coming out of North Korea. We then continue the story, missile continues, Washington has then picked up from the signals and satellites on the shore of the Korean peninsula, fed back into the main data center and then into Washington. Decisions are made pretty quickly. Missile counteracting from Santa Barbara is sent from the US West Coast. By the time then it reaches, even leaving the kind of Asian airspace, a sea-based X-radar has picked it up. Missiles are then counteracted already over really above Alaska. And then that's it. 22 minutes counteracted. It's just quite an interesting way of looking at these various means of self-defense that there are. Similar takes place in Japan, UK, all other major nations. All right, got to talk about Bitcoin for a couple of minutes because we broke 10,000. This is a Bitcoin chart here we're just looking at. This was 10,000. We're just looking at it. We spent the beginning of the week, you can see here on the left hand side of the chart, it got up to that level, and of course, if you were long Bitcoin from, if you were lucky enough to be long Bitcoin, or clever enough at 1,000, 2,000, 3,000, so on, then the big long-term target psychologically would have been 10,000. So that kind of hesitation as we got to the level is probably largely a byproduct of a lot of people just booking that trade. Excellent returns, a job fantastically well done, and so a lot of the money comes off the table at that point. The one thing is though, is that there's likelihood a lot of stops sitting above the level, and if that gets hit, and also the breach of it might then create a whole new wave of buyers who've now seen that level breached, and it brings a whole new group of investors to the marketplace. And what we had last night was when it breached overnight, pretty early hours in London, 10,000, it went from 10,000 to pretty much 11,000 within the space of about 3 hours. So shot higher. We had a really big collapse though, all the way back to 10,000 before then recovering, and we've stabilized now at 10,740. So we've managed to safely navigate our way through 10,000. We're comfortably above that now. Now going forward, a lot of the chat this morning has been, where do you go from here? And although I think a lot of people might have booked that trade now at 10,000, the other thing here you've got to ask yourself, and one of the pundits on Bloomberg was making a good point this morning, was about when you talk about Bitcoin as value, how do you value an asset like Bitcoin? Very difficult to actually do so. But if you're looking at human behavior and trying to read that, of which this market is very much a byproduct of participants' behavioral patterns as well as technical analysis, then one of the things you've got to ask yourself is that of all the people you talk to, are people at 10,000 talking about, I want to sell Bitcoin, I want to come out of my Bitcoin trade, or are they talking about, I want to buy Bitcoins? And I know for sure most of the people that I have met, whether in finance or not, the buzz is about buying Bitcoin, not booking profit. So maybe the smart money has, but I think at the moment, the fact that this has become such a widespread phenomenon, there's still plenty of people out there who are going to want to get in this trade. And now that we've got above 10,000, I really don't think you can rule out the next big targets on the upside. It just depends how long it takes to get there, whether that's 20,000, 40,000 and beyond. The fact that we've got to 10, I don't think rules out the fact that you could go to 40,000, because at the end of the day, how do you value this asset? There is no specific way of doing that. So very interesting with Bitcoin. One of the most interesting thing is, and quite kindly one of the guys in the live room shared this yesterday, and the point here that I want to make is the speed of which the market is now accelerating in these psychological barriers of $1,000 increments. You can see here that as we've gone from 5,000 to 6,000, 10 days, 13 days, 17 days, 7 days, it's just getting more and more violent. Again, I've said this before, you know, if you are a new person to this type of product, do be aware of its extreme nature of volatility. A market that can rise so rapidly in such a short period of time can also fall an equal amount in an equal space of time. So get yourself educated, be aware of the risks and manage those appropriately before you make any type of decision with real money, would be my suggestion for anyone who watches this. Okay, one other thing just to finish off. This was what I saw last night. This was also coming amid the firing of the missile in Korea, the Telegraph sources about Brexit. This also slipped under the radar, but this was Platts. Now Platts is one of the main commodity news providers, and they provide excellent analysis of the area. And they basically said, according to their sources last night, OPEC output caps for Libya and Nigeria could be discussed. You know, we've talked about a 9-month extension, meaning that the current OPEC deal cut, OPEC and non-OPEC being a total cumulative value of 1.8 million, would be extended to the end of 2018 from what is currently due to expire in March of 2018. No one's really been talking though about caps for Libya and Nigeria, and we've talked about the exponential increase that they've seen, having had exemption status from the cut. Nigeria have increased productivity or production approximately 20% since the beginning of the year. Libya even higher, more like 60-70%. If you brought them in and capped them, certainly that does make the potency of the ongoing cut, in addition to the extension, a little bit more powerful. So something to just be aware of. Okay, finally, quick look at the calendar. Let's have a look. And coming up, we've had a couple of German state CPI readings. Just having a look, Brandenburg 0.4% month on month against previous minus 0.1, year on year 1.6. Scanning the other ones, they all look, the German states for the month of November, quite a decent pickup actually in inflation. So let's just have a quick look at the euro. You can see has been edging up. Remember, the pan-German figure you'll get at 1 o'clock is really just a summation of these German state readings. And as the euro's picked up here, given the inflationary picture in Germany is picked up, that's also counteracted some of the bid tone in the equity market and the DAX as the euro is appreciated. Again, the DAX has followed suit, not only helped by the move in higher to all-time highs in the US yesterday, but when that Brexit comment came out, the DAX and Eurostoxx futures also rallied last night. Don't forget, securing a clear deal for Britain and its trade negotiations going forward is also a net positive for Europe in that respect. Looking further on, you've got some mortgage data coming out of the UK. You've got climate sentiment data coming out of Europe at 10 o'clock. I know this sounds interesting, but very rarely does it move the market. The focus really is going to be more to the US afternoon in terms of scheduled data releases. You've got the second estimate of Q3 GDP in the US. This is after we got a surprise to the upside previously. You've then got PCE data. You've got the oil inventory numbers in the evening, so I'll recap the APIs ahead of that event which came out last night. And in speakers, you've got to be aware of a couple. You've got Fed's Dudley, Bank of England Governor Mark Carney, Ramsden, who was one of the dissenters, at 2:45. Yellen as well is speaking at the Joint Economic Committee. Now, given the fact that she is now going to be handing over the reins to Jerome Powell, some think that she might start to speak more freely in regard to the fact that she can really speak her mind. Now, she doesn't really need to communicate so efficiently to the market, given she won't be steering the ship in a few months' time. But Deutsche Bank said this morning, and I agree, she's too much of a team player to, I think, jeopardize the future for Powell. So I wouldn't be expecting too much, but again, just to be aware of. And then you've got Fed's William at 5:45. So a cluster of fairly influential speakers happening this afternoon as well that you need to be aware of. Okay, guys, going to leave it at that. Have a good day. Any questions, I'll be in the chat room. Thank you very much.